Hello and welcome back to my channel, The Barefoot Investor, your one-stop shop for all things investing and personal finance. Today we're going to be talking about the key concept from Scott Pape's book, The Barefoot Investor. The book provides a comprehensive guide to managing money and achieving financial freedom, with a focus on practical, easy-to-follow strategies. The book is written in a conversational and accessible style, making it an easy read for anyone looking to improve their financial literacy and stability. The book begins by emphasising the importance of taking control of one's finances, particularly in light of the current financial environment, where low interest rates, high debt levels, and economic uncertainty are common. Pape stresses that anyone, regardless of their income level, can take steps to improve their financial situation and achieve financial freedom. In this video, we'll cover the essential concepts from the book, which includes budgeting, saving, investing, minimising expenses, simplifying your financial life, and building long-term wealth. So, let's make a start. Chapter 1, The Barefoot Investor's 10-Step Guide to Financial Freedom. In Chapter 1, Pape introduces his 10-step guide to financial freedom, and these steps include: Number 1, schedule a monthly money date. Number 2, create a fire extinguisher fund. Number 3, set up the buckets system. Number 4, domino your debts. Number 5, buy your own home, or at least as soon as possible. 6, supercharge your super. 7, get the bank accounts right. 8, boost your mojo in 60 seconds. 9, automate your money. And 10, increase your income. These steps provide a roadmap for achieving financial freedom, with each step building on the previous one. By following these, readers can take control of their finances, reduce debt, and increase their savings. So, to find out more, listen up. Chapter 3, Why you need to stop budgeting and what to do instead. In Chapter 3, Pape argues that traditional budgeting doesn't work and introduces his own budgeting formula. The formula involves dividing expenses into 3 categories, being fixed expenses, occasional expenses, and guilt-free spending. Fixed expenses are expenses that are consistent from month to month, such as rent or mortgage payments, utilities, and insurance premiums. Occasional expenses are expenses that occur periodically, such as car repairs or medical expenses. Guilt-free spending is money set aside for discretionary spending, such as dining out or hobbies. By dividing expense into these 3 categories, readers can gain a better understanding of their spending habits and make adjustments as needed. He recommends setting up automatic transfers to separate bank accounts for each category, which makes it easy to track spending and ensure that bills are always paid on time. So, in keeping with the same example, let's say that your monthly income is £4,000 and your fixed expenses are £2,000. Occasional expenses £500 and guilt-free spending is also £500. Under this budgeting formula, you would automatically transfer £2,000 to a separate bank account for fixed, £500 for occasional expenses, and £500 for guilt-free spending. By automating your budget and tracking your spending, you can reduce stress and ensure that bills are always paid on time. Chapter 4, The Power of Mojo. In Chapter 4, Pape discusses the importance of mindset and motivation in achieving financial success. He introduces the concept of mojo, which he defines as the emotional state of confidence and energy that comes from taking control of your finances. To boost your mojo, Pape recommends starting with small wins, such as setting up automatic transfers to savings accounts or paying off small debts. He also recommends celebrating these wins to reinforce positive behaviour and habits. By focusing on small wins and celebrating them, you can build momentum and boost your mojo, which can help you stay motivated and achieve your financial goals. Chapter 5, The Barefoot Investment Philosophy. In Chapter 5, Pape introduces his investment philosophy, which focuses on passive investing and diversification. He argues that actively managed funds and individual stock picking are too risky and that most investors can achieve better results by investing in low-cost index funds for the long run. He emphasises the importance of diversification too, which involves spreading your investments across different asset classes and markets to reduce risk. For example, let's say you have £10,000 to invest. Instead of buying individual stocks or actively managed funds, you could invest in a low-cost index fund that tracks the S&P 500. This would give you exposure to 500 of the largest publicly traded companies in the United States, which provides diversification and reduces risk. He also recommends investing in international markets to further diversify your portfolio and increase potential returns. He advises investing in index funds that track broad international markets rather than individual countries or regions in order to spread risk. Chapter 6. The Calm Investor. In Chapter 6, the author emphasises the importance of staying calm and avoiding emotional reactions to market fluctuations. He argues that trying to time the market or make quick trades based on short-term trends is a losing game and can lead to poor investment performance. Instead, he recommends taking a long-term approach and sticking to a well-diversified portfolio of low-cost index funds. He also advises against checking investment account balances too frequently, which can lead to anxiety and emotional reactions to short-term fluctuations. For example, let's say that the stock market experiences a significant decline whilst you're invested. An investor who is trying to time the market might panic and sell their investments, hoping to avoid further losses. However, a calm investor who is focused on the long term would recognise that market fluctuations are normal and is simply the price you pay for being invested in the market and wanting long-term returns, and would actually stick to their investment plan, confident that the market will eventually recover. By staying calm and avoiding emotional reactions to market fluctuations, investors can avoid making costly mistakes and achieve better long-term results over the long term. Chapter 8. Estate Planning, Protecting Your Family. In Chapter 8, the author discusses the importance of estate planning and protecting your family and ensuring that your assets are distributed according to your wishes after your death. He recommends that all readers create a will and update it regularly, especially after significant life events such as a marriage, divorce, or the birth of a child. He also advises against DIY wills and recommends seeking professional help to ensure that your will is legally valid and reflects your wishes. So let's say that you have significant assets, including a house, retirement accounts, and investments. Without a will, your assets could be distributed according to state laws rather than your wishes. By creating a will and updating it regularly, you can ensure that your assets are distributed according to your wishes and that your family is protected after your death. So, in conclusion, The Barefoot Investor is a practical and straightforward guide to personal finance that emphasises the importance of taking control of your finances, setting goals, and developing positive habits. By following Pape's advice on budgeting, saving, investing, and protecting your wealth, readers can build a solid financial foundation and achieve their long-term financial goals. Whether you're just starting your financial journey or looking to improve your current situation, the Barefoot Investor provides actionable advice and strategies that you can utilise to succeed. So, if you're ready to take control of your finances and achieve financial freedom, pick up a copy of The Barefoot Investor and start building your financial future today. And that's it. Thank you for watching. I've been the Midlands Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.